Q3FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Vaswani from CDR India. Thank you, and over to you, sir.
Thank you, Tanvi. Good afternoon, everyone, and thank you for joining us on this call to discuss the financial results of Apollo Hospitals for Q3 and the 9 months of FY23, which were announced yesterday. We have with us today the senior management team comprising Mrs. Sunita Reddy, Managing Director, Dr. Hari Prasad, President of the Hospitals Division, Mr. A. Krishnan, Group CFO, Mr. C. Chandrasekhar, CEO of AHLL, Mr. Obul Reddy, CFO of the Pharmacy Division, and Mr. Sanjeev Gupta, CFO of Apollo 24/7. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature and may involve risks and uncertainties. Please note the disclaimer mentioning these risks and uncertainties on slide 2 of the investor presentation shared with all of you earlier. Documents relating to our financial performance have been circulated, and these have also been uploaded on the corporate website and the websites of the respective stock exchanges. I would now like to turn the call over to Mrs. Sunita Reddy for her opening remarks. Thank you, and over to you, ma'am.
Good afternoon, everyone, and thank you for taking time out for this earnings call. I hope that you have received the earnings documents which we had shared yesterday. We have delivered a steady performance in Q3 FY23, with the healthcare services business growing at 10% year-on-year, excluding vaccines. Growth was driven by an increase in IP volumes, which were 7% higher year-on-year and supported by pricing and case mix gains. ARPOB has increased 12% year-on-year and is currently at 51,482 rupees in Q3. It is important to note that we had reported 41% revenue growth last year, Q3 FY22, which was aided by COVID revenues and vaccination revenues, which was ahead of industry growth. In the light of the high base, the 10% year-on-year growth in healthcare revenues is meaningful and adjusts for non-recurring COVID revenues and vaccine revenues. On like-to-like growth in the healthcare services business is at 17% year-on-year. Q3 FY23 occupancy across the group was 65%. The Q3 FY23 occupancy in mature hospitals is 66% and new hospitals at 62%. We witnessed an improvement in the payer mix too, as cash and insurance segments registered a year-on-year improvement of 28% in revenues. Against this backdrop, let me take you through the consolidated financials for the quarter. Consolidated revenues grew 19% on a year-on-year basis to 4,264 crores after normalizing for vaccine revenues in Q3 last year. Healthcare services revenue grew 10% to 2,194 crores. Healthco revenue grew by 34% on a year-on-year basis to 1,758 crores. Offline pharmacy distribution revenue grew 21% year-on-year to 1,581 crores. Online pharmacy distribution and 24/7 revenue was at 178 crores. Combined pharmacy revenue grew by a healthy 31% on a year-on-year basis. AHLL revenues stood at 311 crores. Excluding COVID vaccination and testing, it grew by 30% on a year-on-year basis. Diagnostics core revenue grew by 62% on a year-on-year basis to 92 crores in Q3 FY23. Healthcare services EBITDA was at 543 crores, a year-on-year growth of 9%. This was supported by volume, price, and case mix improvements. Healthcare services EBITDA margin was at 24.7%, a 15 basis points improvement over last year. Margins in mature hospitals were at 27.5 as against 25.6 in Q3 FY22. Margins in new hospitals stood at 18.2% for the quarter. EBITDA for the offline pharmacy distribution business was at 124 crores for the quarter, representing a growth of 28%. The online pharmacy distribution and 24/7 business reported an EBITDA loss of 186 crores, resulting in a net loss of 63 crores for Apollo HealthCo. AHLL recorded an EBITDA of 25 crore for the quarter. Overall consolidated EBITDA was at 505 crores, reflecting the investments that we have made in the online business. At the PAT level, Healthcare Services PAT was at 261 crores, a year-on-year growth of 30%. Consolidated PAT, however, was at 153 crores. I will now summarize the performance for the 9 months ending December 2022. We closed the 9 months of FY23 with a consolidated revenue of 12,310 crores, a growth of 16% over the 9 months of FY22, excluding revenue from vaccination. This includes a revenue growth of 12% year-on-year in the healthcare services business and in AHLL, and 23% growth in Apollo HealthCo. EBITDA stood at 1,561 crores. Within this, healthcare services EBITDA was at 1,598 crores. EBITDA for mature hospitals increased by 25% year-on-year, with an increase in the EBITDA margins to 27.4% from 24.3% in the 9 months of FY22. PAT for the 9 months of FY23 stood at 675 crores. In operating terms, the offline pharmacy business added 194 net new stores for the quarter, taking the network to 5,196 crores, with private label sales at 11.03%. The online pharmacy distribution and 24/7 platform recorded a strong GMV growth of 85% quarter-on-quarter to 543 crores. The platform added 3 million users this quarter, and its total users as of date is 23 million users. The platform witnessed around 42,000 transactions per day compared to the 25,000 in March 2022. This has been a good quarter for our healthcare services business. Our occupancy and volume levels are robust, and our margins have expanded. There is still room for growth in both the mature and new hospitals as surgical cases increase and international patients return. We continue to focus on the centers of excellence, case mix, payer mix as levers for revenue and EBITDA growth. AHLL has demonstrated resilience in a quarter that was muted for the sector. Our penetration and growth plans for primary care and diagnostics will continue, and we will see improvements in EBITDA and margin profiles. Apollo HealthCo has done really well on the pharmacy distribution revenue and GMV growth and operating metrics. It is on track to exceed 1,500 crores of GMV this fiscal, and well ahead of the information memorandum to deliver 2x growth in FY24. We believe we are at a peak burn rate this quarter and expect losses to moderate from here on. Margins in Apollo HealthCo will improve, with the offline pharmacy distribution margins improving as well as discount rationalization, digital health services revenue improvement, and expansion of private label sales. We expect HealthCo to directionally be PAT neutral by the end of FY24 and become the fastest digital player to achieve segment profitability by FY25. In the larger context, while individual business verticals are all delivering to plan, the largest opportunity for us is the network effect, is really leveraging the synergies across all the formats in both the physical and digital touch points that we have created. We are the only 360-degree integrated healthcare ecosystem, and our clinical proposition remains strong. I believe that we have put a lot of work into our strategy for not just this year, but for the coming 24 months. And we look forward to our next calls to see it play out over the next 24 months. Meanwhile, I have Dr. Hari Prasad, our CFO Krishnan, Obal Reddy, Chandrasekhar from AHLL, and Sanjeev from 24/7 to take questions from all of you. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Anuj Suneja from ICICI Prudential. Please go ahead.
Thank you for the opportunity, and congratulations to the management on the good set of numbers. So I have a couple of questions, mostly related to 24/7 expenses. So one, I would like to understand, what is the breakup of the expense at 134 crores that we are doing? Is it just going to discounts, or is there any other strategic initiative that is also being driven by this number? And going forward, we have given a guidance of 200 crores for H1. So if you are giving the breakup right now, what would be the breakup like 6 months down the line? So that's the first question.
Okay, Sanjay this side. So, let me just talk about the breakup of expenses. That was the first question. As we spoke in the last earnings call, we talked about that, the company is investing in the resources and tech and product side for the new line of businesses which it intends to start. As I recall, pharmacy, diagnostic, and consultation is something which are the firing engines as of now. And during Q3, we invested into product and tech essentially, and some bit on people resourcing for the new line of businesses. Essentially, that is where the most of the incremental expenditure has happened. If I look at broadly, about 30% of the expenditure is into product and tech side. We have about nearly 20 to 22% on the operation side. We do have marketing for acquisition of new customers to the tune of about 15% of expenditure, and something to do with the call centers and sustenance of communication and SMS and all that stuff, another 15 to 20%. And the remaining expenditure happens towards the support side. So that's the broad breakup of the expenditure. I think that accounts for and some bit of additional expenditure in Q3 is accounting for only related to the new line of businesses wherein we are putting money.
Okay, sir. Good. And the second question is, we are reporting somewhere around 1,500 crores of GMV. So what is the GMV to revenue bridge? And going forward, how would the EBITDA look like for this 1,500 crores of GMV, if we can have some thoughts on that?
Yeah, so if you look at it, for the whole or the first or the last quarter, we did a GMV about 543 crores, and the revenue that comes to the books, which is including of the online pharmacy and the take rates for the other services, is about 177 crores. So that is the ratio that we are looking at it. And yes, 1,500 crore, I think we should be doing more than 1,500 crore. The idea, or rather the estimate at this stage is to hit around 1,600, whereas another 2x growth for the next year. As far as the overall investment into the project is concerned, I think ma'am suggested this, during her opening remarks also, that we're looking at somewhere a peak of expenses as far as digital side is concerned. And next year as Apollo HealthCo, somewhere in third or fourth quarter, we are looking at coming to near break-even.
Okay, sir. Got it. So any guidance on the EBITDA front? So say 1,600 crores to 177 crores of revenue, and beyond that, on EBITDA, any guidance?
I think, as we get into the annual operating exercise, for next year and, during this month and first half of the next month, will be detailed exercise done on this. And I think in the next earnings call, probably we can, guide you on the digital side of the EBITDA also for the next year.
Fair point, sir. Thank you. Thanks a lot, sir.
Thank you. Participants, if you wish to ask any questions, please enter star and 1. The next question is from the line of Shyam Srinivasan from Goldman Sachs. Please go ahead.
Yeah, thank you for taking my question. Just the first one on the hospital business. Occupancies on a blended basis have come off 300 basis points. So just want to understand how should we look at the quarter 4, and I think we had an earlier guidance of reaching higher occupancies. So if you could just reiterate or at least observe what those occupancies are and what are our targets for the next, say, 12-18 months.
So, October, December are generally holiday months, and I think the seasonality of the business is something that we have to consider, and which is why our occupancies were around 64%. But having said that, they have picked up in February and March, and we expect to see a higher occupancy rate. Our target was 70% for the year. We will be close to 70%, especially for the last quarter.
Got it. And Ms. Meeta, I think we had a longer term goal also, right? I recollect because...
Yes. So what we said was that our intention is to take it up to 75%. So we do have a target for the next 18 months where we will do that. In fact, it is baked into next year's AOP. And hopefully, we'll be able to commit to absolute numbers after the first quarter of next year is over.
Got it. Helpful. Just second question, just to the previous participant's question on revenue to GMV. So while it is 33% conversion on the 24/7 this quarter, last quarter was like 55% and the quarter before was 56%. So is there any change in how we now get our revenue or the conversion from GMV? Is there any marketplace that makes the take rate lower relative to previous quarters? Is it like are we now starting to recognize revenue from, say, the Amazon platform that is making this take rate lower?
Yeah. So that's a good call out. I think, this quarter, we started the entire IPOP business for 247 users. And typically this business, so it's a question of a mix. What I would broadly say is that, between 30 to 35% should be the revenue to GMV ratio, which we see in this quarter should be the percentage that we can see in the next 1 or 2 quarters. And as we get into more of digital therapeutics and insurance distribution side of it, probably this percentage will further go up. But for the current quarter, as well as Q4, as well as for Q1, let's assume in the range of about 35%.
Got it. And Steve, what is the mix of the revenue? So if you could just help us refresh that as well. How much from pharmacy, what is from consult? Because the commentary seems to suggest that the growth has largely come from IPOP, at least in the commentary on the presentation. So if you could just give us that qualitative color, please.
Yeah, so that's true. Most of the growth has come from the IPOP, which is a new vertical that we started in Q3. If you read through the Q2 transcript, we said that we would be investing into the customer journeys for the users who can come from Apollo 247 and then get the physical bookings as well as get the IP and the other things done. For Q3, little distortion because a new vertical, whenever it comes, starts firing, the percentage mix changes. But for Q3, if I talk about, pharma is about 50% and consultation is about, with consultation together with IPOP is about 45% and rest is diagnostic and VC. Over to consultation.
And this mix for 1H was what? Sorry, so that I just know what is...
Mix of one, yeah. So mix of H1 was about 80% as pharma, and then we had about 10% of consultation and about similar 10% for diagnostic and the subscription and pay model.
Got it. That's helpful. My last question is on the pharmacy business. Both in terms of network addition, I think just a simple observation, we used to add 350 stores annually in the past years. We have now added 757 in 9 months, but now the number of closures are also equal to the one third of how much we were adding earlier. So is there any change in the philosophy? Why are we closing more stores? Maybe it's a percentage of new stores added, but I just want to get the philosophy there. And also a data point on what is the combined pharmacy EBITDA margins. I think we were disclosing it until last quarter. I can't see it in the presentation for this quarter. Thank you.
Yeah, the number of store addition, we continue. This year we embarked on additional stores and expect to open for the full year about 950 stores. And we close around 100 stores, which is more, on the basis of identifying them non-performing, not that it is as a percentage to the store addition. And on the EBITDA, it is about 7.38% on the pharmacy business. Slightly about, say, 50-60 basis points lesser than last quarter, and largely because of the establishment costs on the addition of stores. And with the growth coming from these new stores, in the next 2 quarters, that will considerably change.
Got it, sir. Thank you and all the best.
Thank you. The next question is from the line of Damayanti Kerai from HSBC. Please go ahead.
Hi, thank you for the opportunity. My first question is on your hospital business. So how much is international patient contribution during the quarter, and how do you see this piece moving, say, next few quarters?
So we've moved from 5 last quarter to 7, and we, our hope is that it will be 10% in the last quarter.
So 10% by end of this fiscal?
End of this fiscal, yes.
Okay. Ma'am, my second question is on hospitals again. So we have seen improvement in AP Telangana cluster, which has seen good pickup in the third quarter. So among your all cluster hospitals, which are the segments where you see enough headroom to improve on the payer mix, etc.? So I think last quarter you talked about AP Telangana. So apart from this, which are the segments where you see you are not yet your targeted payer mix level?
So we are looking at our some of the new hospitals which are now ready to ramp up. I think we had moved the whole strategy from being primary and secondary care to tertiary care, and with this offering of tertiary care, we should be clinically differentiated in these markets. So you will see improvement in Vizag, you will see improvement in Madurai and Trichy, and Navi Mumbai coming through in the last quarter.
Okay. Ma'am, my next question is on your cost improvement plan for your business. You earlier mentioned some 150 basis point improvement over the next 18 months. So if you can provide an update on that, and which are the key drivers for this cost improvement?
So I think we're pretty consistent with what we hope to achieve. You'll most probably see it at the end of 23-24. What are the drivers for this? Clearly, we are looking at, creating packages, surgical packages, kitting it out. We're also looking at admin costs. We're looking at HR costs as well. But more importantly, I think the whole initiative is about improving the overall efficiencies within the system, so conversions happen at a better rate. So it's also about growing revenues as well as cutting costs. So I think it's a very crucial program for Apollo, and will deliver on both revenues, volumes, and EBITDA margins.
Okay, ma'am. My last question is, can you specify at your network level what is contribution from cash, TPA as of like third quarter in terms of your payer mix? If you can call out a number.
So almost around 80% is from cash and insurance.
80%. And within that, I assume around 50% is cash and another 50% TPA, like equal contribution, or how is the split is?
Yes, equal contribution.
Okay, thank you. I'll get back in the queue.
Thank you. The next question is from the line of Shalin Kumar from UBS Securities. Please go ahead.
Yeah, thanks for the opportunity. Since I think on 24/7, the nature of GMV has changed a bit. Is it possible to get like-to-like comparison of GMV? How, if I have to see my previous Q2 GMV versus Q3 GMV, how the growth has been?
Yeah, so Q2 GMV was 295 CR, and like-to-like comparison would be about 340 crore. So that would be up by about 15%. So that is like-to-like. So like-to-like here means pharmacy consultation and diagnostics.
Understood. But then, so basically the new GMV contribution to revenue is quite less because if I look at the revenue growth is also somewhere around that, right? 12 to 15% kind of a revenue growth is there sequentially. So the
observation is right, and because one of the questions asked previously also, I guess whenever a new engine fires, the entire mix goes change. And that is going to change in the mix. And so I think it is all temp from that sense. But as we see another 1 or 2 quarters, we are coming out with new line of businesses. This will continue to be slightly different before it starts maturing on 1%.
Okay, so we intend to increase our contribution margin from that, or there's a scope for that?
Absolutely. That's the constant endeavor to reduce expenses and increase your top line as well as the margin.
Sure. Got it. Just one bookkeeping question. There is a cost related to JV and associate. Just try to understand what is it pertain to, and is it like one-off, or it will be sustained or something like that? Around 21 crores.
So that is the consolidation of the front-end pharmacy business. There is this establishment cost also, which, as Obul said, is part of those costs, which is getting consolidated.
Okay, sir. So, sir, should it will it be this level, or how should
it will come down.
It will come down. Okay.
Some of that starts maturing.
All right. Okay, yeah, that's it from my side. All right. Thank you.
Thank you. The next question is from the line of Harith Ahmed from Avendus Spark. Please go ahead.
Good afternoon. Thanks for the opportunity. I'm looking at AHLL, and within AHLL, the diagnostic segment. We've seen a sequential decline in margins. This quarter we had around 5%, with a sharp decline versus the second quarter. Are there any one-offs, and what's the number that we should expect for the segment going forward?
Yeah, I'll answer that. I think on an even basis, I think this YTD number stacks to the range of 8.5%. These are turnover discounts and such other one-offs that have spiked the Q2, but they pertain to both the Q1, Q2 overall. So we sequentially record them as and when the such credits come our way. The overall outlook this quarter has been muted in line with the overall industry trend. There's a 10 crore approximate drop in between quarters, and that contributes to about 6.5 crore of EBITDA for us, considering that the fixed costs are covered. So on a even basis, on a steady state, we are hoping to be in the 8.5 to 10 mark this year. We are continuously growing, so our move from 10 onward is something that we are planning to achieve next year as we start realizing the front-loaded costs and thereof the revenues from areas such as specialized testing and such. So that's the broad view of that.
Okay. And to a previous participant's question, you mentioned that the like-to-like GMV for the quarter is around 350 crores, while what you've disclosed is around 540 crores. So what exactly accounts for the difference between these two numbers?
Yeah.
Sanjeev, go ahead.
I think this pertaining to 247, wherein they want to check on the increase in the.
Go ahead, Sanjeev.
Yeah. So during Q3, we started opening up the customer journeys for booking of physical appointments for hospitals across the whole ecosystem, as well as helping the customers to get the radiology, pathology, and the other IP-related items. And then happy to share some broad numbers. Monthly we have on an average 2 lakh leads that we get for the OP/IP business, and about 22% is the current conversion leading to OPD side of it, and about 6 to 7% conversion from there towards the IP side of it. So that is the line of business that we started. We spent some money into it, building up the tech side of it, tech and product side of it. In Q3 essentially came, realizing the entire GMV. Put together about 200 crore worth of GMV is what we got for the Q3. That's the incremental versus Q2.
Okay, got it. And then for the combined pharmacy revenue that you disclosed for the quarter, around 2175 crores, is there an offline-online breakup for this number that you can share, like we have for the pharmacy distribution?
Yeah. It's about 9% of the revenue is coming from online, rest is offline. As a number, it is 1963 crores from offline, 204 crores from online. Together it is 2167 crores.
Okay. Thank you. And last one with the permission. Can you help us with the timelines around some of our bed additions expected over the next 2 or 3 years? So how should we think about the number of beds from the current 7855, let's say for FY25 and 26?
So in terms of bed addition, I think that, our short-term challenge is on the current bed addition, let's move to 70% occupancy. Over a 24-month period, we are looking at adding beds. There will be 2 brownfields in Bangalore, which will give us another 400 beds. Adding on to this, which is more of from 25 onwards, you will see beds added in both Chennai OMR, a large hospital, as well as Gurgaon, which will come in the year 25. So with that, we will have an additional 1,000 beds in that year. Our plan is really to go to 2,000 beds in the next 3 to 4 years, with a capital outlay of 3,000 crores.
Thank you, ma'am. That's all from my side. Thanks for taking my questions.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. Again, on the GMV, while the rate has been quite exponential for past year or so, and you have given the guidance for FY23 as well, but if you can take this forward for next 12 to 15 months, FY24, how do you see this GMV move?
I think 1,600 crores roughly that we're going to hit this year. Truly 2x growth in any case we'll have it the next year. So that would be anything over and about 3,200, 3,300 crores. However, as I said previously, that our annual operating plan exercise just initiated, and from now to till 15th of March we have in it detail and workings around it. Probably a bit more color on the next year. We'll have it in the next earnings call. But for now, you can imagine you can take as a 2x growth for the next year.
Understood. And on the offline pharmacy side, while the store addition has been quite aggressive over 9 months, but particularly in 3Q, the offline pharmacy sales growth has been much higher at 22%. It was just 8% for first half of FY23. So anything in particular in this quarter? to highlight?
So, we have also added similar number of stores in the Q1 and Q2, which have started contributing to the sales, and the growth is there.
Okay. And so on the current base, even to grow by 15 to 18%, almost 1,000 stores at least to be added every year. So is that the number to go by in the coming years?
No. With the 1,000 stores, we are growing at 24%. At 21 to 22%, we will have normal 500 stores addition, and the growth coming from this will be sufficient for us for the next 2 years.
Okay. And just lastly, the private label as a portion still remains relatively low. So any efforts out there to improve that?
No. The stores are increasing, and the new stores, it will be slightly less for some period, number one. Number two, if you go back to the earlier period, there was a lot of COVID portfolio, which is not there currently. So we are seeing like-to-like on these SKUs volume growth. So maybe it will take another 2 quarters for us to show the growth on these from here on.
Okay, sir.
Yeah.
Thank you. Next question is from the line of Kunal Randeria from Nuvama. Please go ahead.
Hi, good afternoon. So my first question is on the 24/7 business. Now, if I were to look at your revenues, it has grown from around 120 odd crores in Q1 to around 177 crores in Q3. But at the same time, the OPEX that you are doing has grown in almost exactly the same proportion, which is at 100% of your revenues there. So I'm just wondering, going forward, so assuming the revenues will be more than double in a year and a half's time, which cost items can be controlled so that, as ma'am mentioned, you can also turn profitable?
Yeah, so I think what we need to actually look at is that, now we are in the 4th year. So 1st of February, we stepped into 4th year. So I think, it is something like, one of the fitness centers, have the traditional line, that today's pain, tomorrow's gain. I think more or less, we are off the mark of, putting up more investment into the tech and the product side. I think our app, website, our individual customer journeys within, and the entire integration with the service providers, all that is more or less done. So that means, going forward, as we scale up, as we get more GMV, more revenue, my cost with respect to product and tech will not be in that proportion, number one. I think on the number two side, on the resources side also, we are adequately staffed, so does the office infrastructure and the other things. I think what we can clearly save further on existing costs is the discretionary expenditure on the marketing side of it, which is to do with the branding. And I will just, recall this point, a couple of earnings call back, had talked about this, is that the users were also to be talked about various, benefits that they can get from the Apollo 24/7 app. So to that extent, we had to do a lot of campaigns and marketing to make them aware about the fact that you can now easily put your, medicines on the app. You can get the diagnostics done through the app. You can get the consultations, physical bookings, so on and so forth. So all that is something which is now past, and all that expenditure is kind of a discretionary expenditure today. So, cut short, I think, going forward, we would get more scale on a very low incremental cost, and we would have higher margins. So we should be able to do a better job as far as the EBITDA side is concerned. So possibility is very high to do a pretty good job in the next fiscal year for the EBITDA line for the digital side.
So I maybe understand this maybe to a bit more. So would it be sort of fair to assume that you are now at a tipping point where, let's say, for the next 100 crores in revenue, quarterly revenue, you need not spend 100 crores, but maybe spend maybe 40 crores or 50 crores to achieve the 100 crore revenue?
Absolutely. I mean, I don't know about 40 or 50, but absolutely. Now at the scale that we have it, we don't need to spend a lot of dollars to get, fulfill the, upside on the revenue. So I think the system itself, the engine itself will take care of the additional revenue without any additional cost.
And this we should see from the coming quarter, or it will be next fiscal?
No, I think some benefits will start seeing it from Q1 itself, and those benefits will start coming down as we move forward beyond Q1.
Got it. And just one quick question on hospital side. Your ARPOBs are close to 60,000 rupees in metros. And just wondering what the headroom over here is, especially considering that, you already have 80% kind of patients from cash TPA, which is almost, at an optimum level. So what kind of, maybe ARPOB growth we should assume in the coming years?
So we will continue to go with what we have been doing in the past. I think a combination of case mix and price increase is what you should factor in. You're right, we have not been guiding you towards anything specific around change in payer mix. We will continue to work on the payer, but as Sunita said, the payer mix opportunity still exists in non-metros, which is what we are focusing on. In the metro cities, we would not have much of payer mix opportunities. But so you should look at the ARPOB growth of around 8% CAGR, which is a combination of 4-5% on pricing and the balance on case mix.
Perfect. Thank you very much and all the best.
Thank you.
Thank you. The next question is from the line of Rishabh Tiwari from Allegro Capital. Please go ahead.
Yeah, hi. What was the combined pharmacy EBITDA number for this quarter? I think it was not mentioned in the presentation this time.
Yeah, that was a miss in the presentation. We'll put up the presentation with the number. 7.4% is the number.
Okay. And also, I'm not sure if this is a miss. The number of new hospitals has been brought down to 14 from earlier 15. So
yeah, there was one hospital which got transferred. There was the Karapakam Center in Chennai which got transferred to Apollo Health and Lifestyle. This was a hospital which was within the AHCL books which got transferred to Apollo Health and Lifestyle. That's a cradle business that we had within Apollo, which got transferred to Apollo Health and Lifestyle. That's why it's gone lower by one.
Understood. Since you mentioned AHCL, so does the management see any specific guidelines or regarding the margins going down in AHCL?
Yes. I think the quarter three margins at a console level, we are at about 10% at this point of time. The quarter three on a YTD basis. On a quarter three, I think we are lower essentially because of an aberration on account of an October, which actually dragged us into a negative EBITDA zone. And November was a muted recovery. So it is not very representative of where we stand in terms of how the businesses are performing. Having said that, despite these seasonal fluctuations, I think the revenue build-ups have been, especially in the core businesses, minus the vaccines and the COVID testing, which were one-off, continues to be a robust growth. So we are hoping to have a sequential improvement quarter-on-quarter on our margin profile going forward, because we are also front-loading some of our costs as we are on growth path both in primary care and diagnostics. So these are likely to remain a little muted for some of quarters in comparison to the industry.
Okay, understood. Thank you.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, thanks for taking my question. So two questions. One is on the pharmacy business. On the offline pharmacy piece, what kind of growth rate can we assume for the next, say, 2 to 3 years? And, does that really, and do we see incremental operating leverage on the margins on this revenue growth?
Very difficult to guide you for next 2 to 3 years. At least next 12 months, we expect to be in the range of 20 to 24%, given that we have invested in the growth during the current year.
And sir, on the margins, we've been kind of flattish to little muted on the margins for the business. What is our trend that we've been consistently increasing these margins in the past?
Margins, as we have last guided you, we expected that customer discounts will be in the range of about 13.5%. But we could see at the ground it is moving to 14.5%. So we are largely muted on the margin. Whatever increase in the customer discounts, we were now able to manage through the additional procurement margin but still there is about 30-40 basis points impact on the EBITDA. We will be managing that at this level because now we are at about 14.5% on the customer discounts, which we consider very decent for the off market to sustain the growth.
And secondly, Sanjeev, on the online business, we talked about the healthco being PAT positive or EBITDA neutral by the second half next year. When does the online piece on its own start to become EBITDA neutral in your assessment?
That would take a little bit of time. I don't see that to happen, in the calendar year of 2025, but somewhere in the fiscal year of FY25, maybe in the last quarter, that should be the time when we should see this segment as coming profitable. There are a couple of engines that we need to fire. We're working on them. Potential is huge, and if we are able to execute well, which we believe that the current set of team members should be able to do well. Once we do that, I think we should be able to give you better guidance on the timeline. But FY25 should be the year where we should think that digital would also be as a segment EBITDA neutral.
This is towards the end of the FY25.
That's right.
And so we talked about the doubling of revenues on this business next year. So I think earlier we talked about $1 billion in revenues in this business in next, I think, for 3 years. So can you refresh on the revenue targets for the online business? By when do you get to the $1 billion number or thereabout?
I think FY25 should be the year when we should look at numbers closer to $800 million to $1 billion, and that is the scale which is required to ensure that you have a high repeat rate, you have a high net margins, and you're able to leverage on your fixed expenses, and you're able to do justice to the entire economics. So I guess if we, as I said, that next year the numbers are still to be worked upon, but if you're looking at roughly 2x growth, another similar growth for year thereafter. So I think FY25 should be the year to do, get into $1 billion mark, near $1 billion mark.
And at that size, in your, I guess, what kind of margin this business you should be ideally making at that size?
So I think anything around 20% should be the margin that we should get it as a blended margin, and it all depends upon the mix that comes. Little difficult for me to give you one number, but yes, anything between 20 to 25% should be the mark.
And our operating costs, you say we're probably getting to a point where they'll start to plateau out beyond a point. After some time versus the current base that we built in.
Yeah, absolutely. There's no. Pretty much it's a fixed expenditure. Once you have a tech product done, then it is just a maintenance cost. And digital platforms help you to get to the scale faster. But yes, in the initial years, there is a pain with respect to putting up expenses and putting up lot of infrastructure there. But at that scale or from next year onwards, I don't see that expenses going up substantially. They will start getting plateau, and we would also do certain bit of rationalization. Given the fact that we understand the external environment and what are the right decisions to be taken for the business, and I think those business decisions would also be implemented, executed. So I think it will mix up everything. But yes, expenses start getting there.
And the last one, on the diagnostic business, I think we've had some, from an industry participant perspective, a lot of mixed commentary around the outlook for the organized business in the near term and in the near to medium term. Chandrika, how are you looking at the dynamics of the business? Is there some challenges on the organized sector volume growth that's sort of come up over the last few quarters?
So I think there has been more than normal competitive intensity on from the digital aggregators. But the way I see it is this is on the top 20, 25, if not 30 frequently used tests, which form the bucket of routine. So I guess the competition is intense there. And so I believe that it's going to remain that way for a while. But I think the focus of the more organized, larger players and the right resource shift to more specialized and more high-end testing and also towards packages with an emphasis on quality. Because I think at the end of the day, I think these are 95% of all clinical decisions are taken on the basis of these diagnostic tests. So it's important to also bring up the topic of quality. So there is a cost to it. So I think pricing for organized players in terms of responding to such competitive pricing from digital aggregators is not likely. There could be some short-term dips in volumes in the routine basket, but the endeavor for the organized sector will be to make up for that through other semi-specialized, specialized, and super specialized buckets. So that's, I think, the outlook that I think we will see. But this will settle down. Yeah.
Yeah, so last thing on this, there's been a lot of emphasis on selling bundled packages versus illness specific illness tests and is this a strategy that we are also following in terms of trying to increase our share of bundled tests?
So we are following that. In another business which is not reported under diagnostics, actually the clinics business, which is in the primary care, I think we do a lot of health checks. I think 60% of the business there comes out of health checks, which essentially also has a radiology component, but essentially a lot of pathology. But within the diagnostic business, like to like, in comparison to other larger organized players, our wellness packages are now around 7 to 8%, 8% of our mix. We are hoping to make this go to 20%, and that will offset these, very stark comparison in terms of a la carte testing.
Okay. Thank you, sir. Best luck.
Thank you. The next question is from the line of Shantan Maji from Credit Suisse. Please go ahead.
Yeah, thanks for the opportunity. So my first question is on, discounting level. So you mentioned the discounting level has increased from 13.5% to 14.5%. So can you give a split of your discounting level in offline and online pharmacy? And, if this increase is happening in online pharmacy, so do you see an increasing, discounting pressure again in this segment, which is causing the higher discounting level? And also, can you update on the Amazon partnership?
The online discounts are at about 18 to 18.5% like last quarter. It is only offline which moved slightly. And on the Amazon, Mr. Sanjay will comment.
Yeah, so before Amazon, I think, we guided on the online discounts that, we would retain 19% mark. So YTD December has been 17.6, although the last quarter was 17.8. So I think we'll continue to maintain discounts, near 18%, and we'll also time our discounts in such a way that, wherever opportunities are there to reduce it, we'll continue to do that or sustain at this level. On Amazon, we are now live in 30 with 15 stores, and current rate is around 3,000 orders per day. We couldn't increase the run rate in the middle of the year due to tech integration, issues which we had between us and Amazon, but now those have been resolved. And there will be a little bit of network expansion also to take care of Amazon operations. And in the next 4 weeks, we will see that Amazon customers will be able to see breadth and depth of inventory, across the top 6 cities to start with. And there's a little bit of marketing activity also in Amazon app that has started over last 3 to 4 weeks. And what we believe that we should be able to hit a 10,000 orders per day somewhere in July, August of current year.
Got it. And what is, so are we doing a revenue sharing arrangement here, or is it on, profit sharing basis?
It's a revenue share.
Okay, got it. And my second question is on, little clarification on the new GMV. So this hospital IP/OP segment, so is it, the same customers who are coming, they are basically being converted online, or is this, new set of customers that you are targeting here? Can you explain a bit about this IP/OP segment?
Yeah. So this is a new set of customers, and obviously, there is no point in having the same customers both sides. So it is a new set of customers. So the way the entire, operational side of it works is that one is that, we have integrated our 247 app with the entire Apollo ecosystem. We have about 55 participating hospitals at this, which in the current quarter we go to 70. And first, second, there is an engine that works behind all this. People who search out, surgeries, say suppose you don't need surgeries or some kind of surgeries online, googling and all that stuff. Those are the data points that we collect, and then those are the curated leads, that we use to further engage with them. As I said, the monthly average for Q3 was about 2 lakh leads that we got from various, I would say, websites or the places where digital customers were trying to find out about those surgeries, and those 2 lakh leads were then we engaged with them through telecalling and through various, nudges that we do it from Apollo 247. And finally, we converted about 22%, 22.54% to be very precise for last quarter. And about 45,000 customers went on, during the month of December to the hospitals, and they got the OP consultations done. And from there, about 2,500 people got the surgeries done. So this is all, this is a well managed and a created engine, and then you've got many apps out there in the market who does this kind of a work, wherein they identify people who are digitally looking out solutions around surgery, and those are the leads that we get. Those are leads we further cure, and then we further engage with them to get into the this side of the business. So it's all very different. I mean, I can discuss a lot more, but in the interest of time, not much about this, but happy to engage with you one-on-one whenever you want a bit more information about this.
Sure. No, that's very clear. That explains. And finally, just wanted to check what will be the loss run rate for Apollo 24/7 going ahead now that we have peaked?
Yeah. So I think, first of all, we are cognizant to the fact that, somewhere we need to convert the entire to, EBITDA positive. And we are also looking at how we build our plans for the next year, which are the segments we need to fire more, and where exactly we need to do incremental investment. And all this will result into a detailed exercise of, building a budget for the next financial year, and accordingly we get to know about the expenses that we feel appropriate for the business. And accordingly we'll have a little more color on this. So maybe next earnings call will be the right time to discuss about, this by quarter. For the entire year, we can talk a lot more in the next earnings call. So I would just request you to wait for some more time before we dialogue on this.
Sure. Thank you so much for answering the questions. That's all from my side.
Thank you. The next question is from the line of Bhagwan Chaudhary from Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity. So one question on the healthcare side, can you comment something on the future capex side, how we are going to do this, and as we are going to generate a lot of cash, 1,500 to 2,000 crore kind of. So can you comment something on that?
Yeah, so, clearly, the plan, as Mr. Rita already articulated, is to get to a, additional 2,000 beds over the next 3 years. And we have a clear plan on how roadmap on where we are adding that. And the free cash flow, as you already know, is around 800 plus crores that we have in this segment across, and we will deploy this into some of this. So we don't think we're going to be requiring significant incremental debt. Whatever it's required, we'll take some debt. Debt EBITDA is also very comfortable, as you've seen.
And this will be organic or inorganic? How it is going to be?
Most of this, there could be some inorganic, some bolt-on acquisitions that we are looking at, and also a greenfield.
Okay. And secondly, can you talk about this performance of Proton, how that is doing?
Proton is doing much better than now. I think it's now doing so. This year we are in track to get to 50 crores of EBITDA in this year, and we would expect it to. We would like it to double in the next year. That's our plan.